Hello everyone, welcome to today's US Open live session. It is Thursday, February the 8th, 10 minutes before Wall Street opens in our usual time slot every day. I'm your host Nikos Zaboura, Senior Financial Editorial Writer at FXCM. We had some exciting quarterly reports overnight, most importantly entertainment giant Disney, who posted strong earnings, gave a big guidance, and announced key initiatives, especially around its intention to move its sports programming into streaming. We've already covered this all week, and we'll talk now about the latest development and, of course, the impact on the stock. We also had chip designer ARM Holdings, which was last year's biggest initial public offering in the US, surging at this point at pre-market around 20-30% after offering a bit guidance. And we also had disappointing inflation data from China, another contraction, deeper, the biggest contraction in nearly 15 years. And we're also going to talk about how this reflects to the stock markets of China, mostly the Hang Seng Index. These are the main themes of today's session. Before we begin, however, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and the disclaimers carefully. I'll give you a few more seconds to do that, and then we will begin. Okay, let's get the ball rolling. We have quite a few exciting things to cover. We're gonna start with the least exciting, the euro dollar, which um, doesn't have any firm direction but retains this uh, downside bias. Uh, then we're also going to talk about the Nasdaq. We have covered it extensively. Not much going on there either. And then we're going to go into the more interesting stuff: China's inflation figures and the Hang Seng Index, and of course the quarterly results of Disney and the impact on the stock, and similarly for chip designer ARM Holdings. Now, uh, we talked yesterday about how the euro dollar was finding some reprieve, but today it faces renewed pressure. As such, there is still risk for um, a new low below the December low that had supported it previously, which would expose it to the 76.4% Fibonacci of the recent earnings. Now, we had said that it was trying to surpass the 50 line, the RSI, which would be a signal for further strength. That didn't happen, but there is a lack of firm direction for sure. The common currency still have a chance to rebound. towards the 200 period DMA at around 1.0856, but it will need a strong catalyst for daily closes above it that could pose the bearish bias. So a little bit of a mixed situation here in lack of catalysts, but the bias is clearly on the downside. All in all, the drop has been mostly due to the repricing around the Fed as the central bank pushed back against aggressive rate cut bets by markets. And however, the policy differential is a bit murky, but at this stage, the ECB is more hawkish than the Fed, and that could provide support to the common currency. Let's get over to the Nasdaq 100 now. Again, not much to add here. The tech-heavy index largely overlooks the more subdued expectations around the Fed, as sentiment is good on Wall Street because of the conviction of a soft landing and mostly strong quarterly earnings by tech mega caps and of course other companies, but there is slow progress. Now, it remains poised to tackle the 18,000 handle, but once again, we see a bit of a slow progress, and that creates scope for a pullback. But for this outlook to change, there would need to be a move below the 200 period DMA, close to the 17,100 mark, and that is a tall order for sure. Of course, if there are any questions or your opinion on what we're discussing, please feel free to type them in the chat box. Now let's get to the more exciting stuff, and starting with China's inflation figures. We already gave a preview of the situation in yesterday's session, and now we have the numbers out, which showed that China's deflation intensified last month as the consumer price index contracted by 0.8%, the biggest drop in nearly 15 years. And in any case, you can see that it has been around 0% since in almost a year now, since April 2022, roughly. We have already talked about how after the initial boost from abandoning the strict zero COVID policies, the economy got a boost, but then began to falter again. And one of the most concerning aspects of it is weak consumer demand. Now, of course, the poor state of the Chinese economy and the property sector, of course, reflects to the stock markets, both in mainland but also in Hong Kong. And we have the Hang Seng Index here on our screens. It plunged in the second half of 2023, and the new year did not start. You can see here we could see a move like that, but sustained weakness below it does not look easy. On the other hand, it sort of tries to find some reprieve this month, and authorities have been taking some action, and we can see a recovery effort, but some strong catalyst will be needed for it to challenge the highs from December above 17,000, 17,139. Now, all in all, as we said, Beijing has tried to support, to prop up the economy and domestic demand and the property sector, but it has adopted a piecemeal approach that has failed to inspire markets. It will need bolder fiscal, definitely fiscal and monetary stimulus, but as we also referenced yesterday, both have caveats, because bolder fiscal stimulus would endanger the country's credit ratings, and local governments are already stretched, the financial of local governments. And on the other hand, bigger monetary easing would put pressure on the already weak currency, which the country tries to support with the daily fixings. Of course, the Spring Festival gets underway in China, so stock markets will be closed some of the following days there due to observing the holidays. And now, with 2 minutes into the US session, let's turn our attention to Disney. Disney impressed with its results and announcements this week. We've already talked, we gave a preview a few months back, and we talked about the developments around its sports streaming collaboration. The biggest point of yesterday's results were the significant rise in earnings per share and the projection for a 20% increase in the full fiscal year, and a 50% hike in dividend as it faces activist investors. The company hadn't paid dividends for 3 years and reinstated only this January, and now it moves to hike it substantially. Moreover, the company added subscribers for second straight quarter to its streaming services, and the financial of the sector continued to improve. And let's actually see a graph to illustrate this. You can see how over the past few quarters revenues have been rising. That is of the financial of the streaming, the financial of the streaming segment, including ESPN Plus, and you can see how losses, operating losses, have been narrowing. Okay, so markets definitely liked the results. You can see this big surge over here, which is of nearly 10%, 9%. And this brings the 2023 high in the spotlight over here, near $120 per share. And of course, then the next major and critical resistance points is the 38.2% Fibonacci of the advance of the slump, from the 2021 record highs. We had already analyzed over the previous days how there is potential for growth in the stock after the recent slump, and how this golden cross formation here, we had talked extensively about it, is often seen as a precursor of such strength. Now, a few other important things around Disney. CEO Bob Iger said further plans for taking the company's sports offering into streaming, following the collaboration with two other media giants. That is one way to do it. The other is that it will create a standalone app for ESPN that will be more immersive and different than this joint venture. And overall, he offered upbeat messaging and spoke of a new era for the company after the recent hardships. Now, of course, as we said, markets reacted positively. Of course, you can see how the relative strength index points to extremely overbought conditions, the most overbought conditions since 2019. So that definitely creates scope for a pullback, but the downside appears well protected, especially from around 94 and below, with the two exponential moving averages, the daily Ichimoku cloud, and the January lows. And now let's turn our attention to ARM Holdings. You can see another big move here. Of course, ARM is a British chip designer that licenses its architecture to other companies, with nearly all of the world's smartphones running on ARM-based processors. The company went public on the New York Stock Exchange last September in the biggest initial public offering of the year, and as of yesterday's close, had a market valuation of nearly 80 billion. Yesterday, overnight, it released its second quarterly report as a publicly traded companies, and markets liked what they saw, especially on the guidance front. And you can see a big jump today above 80%. Of course, the IPO price was at $51, and now you can see that it trades more than double of this price, well above the $100 threshold. Now, revenues of the company were up 14% year over year, beating estimates, and earnings per share were also strong, and the company guided for a rise in the current quarter for both revenues and EPS. It also raised its full year guidance for both. And it also touted AI as a driving force, artificial intelligence. And of course, this comes on a backdrop of an improving semiconductor market after a poor 2022. Now, of course, there's not much to talk about technically. It's in uncharted territory. It only has a few months of trading, but there are definitely prospects for more growth, but definitely there are some reasons for concern. One of them being the sky high valuation, and we've seen markets being weary of such market caps from time to time. And another area of concern for ARM in particular is its exposure to China, given the strained Sino-Western relations, and especially the tech trade wars. Of course, you can see some key support levels on the chart, but a significant change in sentiment would be needed for them to be breached. Now, that's it pretty much for today. We will talk again tomorrow, 10 minutes before Wall Street opens. As always, thank you for joining me.